If you're thinking about acquiring a business, did you know that you could obtain reps and warranties insurance? This type of insurance is becoming more common in middle market M&A deals to replace escrow mechanisms, protect relationships with rollover management, and assure collection in the event of a breach. The M&A deal-focused professionals at ABD Insurance and Financial Services is a full-service brokerage and consulting firm, crafting innovative solutions to help address risk for clients of varying growth sizes, stages, and industries across the globe. For more information, you can visit their website at theabdteam.com or reach out to Matt Soma at matt.soma, S-O-M-M-A, at theabdteam.com. You can also listen into episode number 38, where Matt and I discuss this product in more detail. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
We all know how daunting the tax code is for businesses and how quickly the landscape can change. That's why I am thankful there are people like my guest today, Roman Basi, the president of the Center for Financial, Legal, and Tax Planning. He lives and breathes the tax code to help business owners maximize their tax situations. I'm excited to unpack some of the recent tax changes with Roman and the impact it's had on the businesses. From my perspective, the tax burden on the acquisition or sale of a business is one of the most overlooked aspects of transactions. So often, the owners that we work with get hyper-focused on the top-line value of a business, not realizing that a well-thought-out tax strategy can significantly alter the need for a specific top-line number if your net proceeds from the transaction meet your objectives. Roman, welcome to M&A Unplugged, and I'm certain you see a lot of what I'm referring to in regards to top-line valuation versus net proceeds.
Absolutely, and thank you for having me today, and we absolutely do see a significant difference in the valuation of companies and their net after-tax cash flow of the transactions.
You know, I always wonder why people overlook this. You know, we've worked with your group on a number of occasions and with your dad in particular. And, you know, every time we've engaged you, you've come in and we've been able to move the needle in a significant way for our clients from a tax perspective, to the point where they're like, oh my goodness, I don't need to get that valuation number that I thought, because look at what I'm going to walk away with. And it's such an eye-opener for folks. And we really try to get people to do this early in the process or even before the process starts. But it's just something that people just can't wrap their heads around for some reason.
Yeah, Dominic, it is vital to the transaction. And we work on these on a daily, if not hourly basis. We've got a couple people here in our office that focus solely on these tax and cash flow analyses. And really what we're doing, and I have a little rundown chart I wanted to explain today. You know, really what we're doing is, first off, we're looking at the valuation. We're looking at the proposed sale price of the business, the proposed marketing price of the business. And first off, we look at what are your expenses of the sale going to be? Those are going to first change the tax structure. Then we look at what's the current balance sheet of the company and what can we allocate to in the transaction. If you're a seller listening to this, if you're a broker listening to this today, allocation is crucial for what we do. How can we minimize the taxes on the transaction based upon the allocation structure? From there, we look at, okay, how much goodwill can we inject into this company? Does it have goodwill? Does it have company goodwill or enterprise goodwill? Does it have personal goodwill? to the owners. We're dealing with this every single day right now. What about liabilities? What liabilities are being required to be paid off? Folks, if you're listening today, the payoff of a liability at closing is not a deduction for tax purposes. You still have to allocate to that amount and pay tax on that amount. So we're looking at that to structure it as well. Also, we're looking at liabilities that are assumed. We're going to say what liabilities is the buyer assuming in the transaction. Then we can take a look and say, okay, what are our taxes going to be on the sale? What is our net cash flow going to be to our owner after the taxes? And then we're also breaking out, is there a seller note that's involved? If there's a seller note that's involved, typically that'll lower the taxes because it's spreading out the income over the next couple of years for the seller. Also, we look at earnouts. Is there an earnout? Believe it or not, there's supposed to be an interest component to an earnout. A lot of people in the industry don't understand that. But when a seller has an earnout, part of the earnout is income and part of the earnout is interest. Also, we don't like to call them earnouts if we don't have to. We look at them as what we call a purchase price adjustment. It impacts the taxes. Again, trying to lower it. Then in that same analysis, we're also looking at what are your local taxes? Are there sales taxes on the sale of the inventory, on the sale of the equipment? Even though it's a one-time sale of a business, some states, I'll use an example right now. We're working in Kentucky on a deal. In the state of Kentucky, the sale of equipment, even if it's a one-time sale, is taxable. So it's a sales tax has to be applied. We look at that. Sometimes promissory notes are taxed. The state of Florida taxes a note. So if the seller takes a note, it's taxable. We look at rent, security deposits. And then finally, we want to look at the personal tax rate of the seller so that we know what are the taxes that the seller is paying personally, so that when we distribute the funds out of the sale of the company, if we're winding the company down after the sale, what is the seller going to receive as a distribution? Maybe it's a C corporation and not a pass-through. And so we're looking at that tax impact. Or maybe it is a pass-through. So how much is going to be taxed personally to the seller? So those are the things that we look at in the tax analysis.
Well, what you're really pointing out here, is all the complexity, right? Look about all the things that you just hit on. There's so much complexity to this, which is making the point that we were talking about is you can't and you shouldn't overlook the tax analysis of a deal. And my opinion is you should do it before you're even in a deal. Understand what the best outcome is so that your advisors in the deal can be negotiating towards that. Why wait until after you have an offer in hand? Do it up front, right?
It's the ideal component. If you do it up front, then you've got a better idea how to negotiate to get the bottom dollar that you want to get out of the transaction. Absolutely.
So, Roman, I really wanted to talk to you today about the tax code and some of the changes that, really sort of maybe fly below the radar screen for a lot of business owners and they don't realize it, and the impacts that those have on their business and potentially their walkaway or even structuring their walkaway. So maybe highlight for us a couple of the top line changes that have occurred, and then maybe we'll dive in deep on a few of those.
Even before I go into the top line changes, I do want to make a comment that last week it was announced that President Trump is looking at the extension of the tax expirations that expire in 2026. So we're expecting tax cuts 2.0 in the very near future. And the majority of that will be an extension of these. The first one of which, when we look at these high level tax elements that have come into play, the first of which is the opportunity zone funds. These are the newest thing that were in the last Tax Cuts and Jobs Act. And the overall theme is this: for a seller of a business, there's potential to offset all of the gains that are made from that investment sale if the investment is held over 5, 7, or 10 years. In a nutshell, if a seller has capital gains from really the sale of anything, and of course, in this realm, this world we live in, from the sale of a business, if a seller has capital gains, they can invest those gains in an opportunity zone fund. These are funds that are set up across the country. You can go to a broker and invest in a fund, or you can set up your own opportunity zone fund. Certain things have to be done. If the money is put into the opportunity zone, the gains, if the gains are put into the opportunity zone fund, they can be held there, and the taxes on those gains are, right now, they are deferred. So
wow,
it's very...
That's unbelievable. And then before we dive into the specifics, let's take a step back up. Describe an opportunity. I mean, it's fairly obvious, but I'm sure there's some nuances to this. So could you describe what an opportunity zone fund is exactly?
So the IRS created zones across the United States of underinvested, low-income, economically depressed areas. In the beginning, there were only about 31 of these zones that they created of these low-income areas that needed investment in the United States. That's what the opportunity zones were. Then they expanded that. Now the listing has almost every single zip code in it. You can find an opportunity zone in your community. And then it expands a little bit and it says, okay, so now you have to either invest in a fund in one of these communities, or you can start your own fund. And the idea behind it is that it's going to spur economic development. You don't have to live there. You don't have to work there. You don't have to have a business there. The zone and the fund are separate from you, the investor.
And what are the rules and regulations around these funds? Is there a minimum amount of investment of money that has to be put into the fund? You have to distribute X percentage on an annual basis? What are some of those key tenets of these funds?
There are some real keys. The essential element right now is that if you put your capital gains into the fund, and if you leave it in there for 5 years or less, right now your benefit would be that you've deferred the capital gains that you put in there. So if you've sold your company, you put all of your capital gains into the zone fund, you do not pay any tax right now on those funds. So you can sell your company and pay zero tax when you roll these into one of these funds. If you pull them out before 5 years, it's fine. You just pay the tax at that time. Very similar to like a 1031 exchange and ending it.
And Roman, just to be clear about this, are you paying the tax rate at that point in time, or is it the tax rate from when you sold the business? What tax rate is being used when you pull those funds out?
When the gains are deferred, they're not recognized until you pull them out of the fund. It's just like a 1031 exchange. You're not recognizing the gain. You're deferring the gain until a later time. So then depending upon the law at that time, depending upon the extender law that we may get in 2020, that answer may be different. But right now, it's a deferral.
Got it.
So you put the gains in there, and after 5 years, you would, if you pulled them out, you would then report the gain and pay the tax on the gain. If you hold them for 5 years, you then get a 10% step up in basis on the existing gain that's in the fund. Let's make it simple. If you put $100 into one of these of capital gain, after 5 years, now you're only taxed on $90. That's the benefit to hold it for 5 years. If you hold it for 7 years, we've already lost part of the new law, because as of December 31st, 2026, the law expires. So on December 31st of 2026, unless we get an extension, which I anticipate we will here, then you owe the tax on the original gain, which at that point would be what? $90. You've held it for more than 5, but less than 7 because the law expires. If the law gets extended, if you hold it for 7 years, you get a step up in basis of 15%. So you get $15. Now you're only paying tax on 85. We have to have an extender for that to happen. However, there's one final piece to the puzzle. If the investment is held for 10 years, you're still deferring your tax, right? Other than the 12/31/2026 date, you pay your tax on $85 on 12/31/2026. Now you have $85 of original gain in there, deferred. And that money in 10 years should be worth significantly more. Let's say it's worth $200. After 10 years, if you hold it, I don't care how much longer you hold it, you will pay no tax ever. It is not a deferral. You are only deferring $85 of gain. The rest of the gain is exempt from tax.
Wow.
A big difference in terminology. Yes.
That's amazing. That is unbelievable.
Imagine when you're rolling $1 million investment, and in 10 years it's worth $2 million, or it's worth $1.5 million, or what, look at the rules of 8. I mean, does it double in 8 years? That gain is exempt from tax, and that part of the law does not expire.
That's incredible. That's incredible. Yes. So, Roman, let's go back to, are there minimum thresholds? Do you have to invest X amount of dollars? I'm assuming you have to put the money to work in some way if you're setting up this fund. You can't just open up a fund and have the money sit there. What are the rules and regulations around how the money gets deployed in those opportunity zones?
There are specific rules on how much of the investment has to be utilized for the economic development. There are also specific rules in terms of the valuation of the zone. I believe it's within 36 months, if I'm not mistaken. So you have to pay very specific attention to code section 1400 Z2 to look at what your investment has to do. But that's why they're called opportunity zone funds. You can't just invest the money into a zone and not do anything with it. The zone fund has to be working. The one thing that has to be done, and I wanted to make mention of this, is that, and people don't know this, when you sell the company and you've got the capital gain, because we get a lot of questions at the end of 2019 because you had to make the investment by 12/31/19 in order to make it 7 years. So we got a lot of questions. Roman, I sold my business in August. Am I limited? When do I have to invest the money? You have 6 months from the date of the sale to make the investment. So that's the first kind of numerical timing you want to watch out for. When you've sold your company, you have 6 months to invest the capital gains. Now, make sure you know what you're doing when you talk to your brokers like Dominic and your advisors, that you are, as a seller in an opportunity zone fund, you're allowed to hold on to your gains until you make the decision. So we had people call us and said, Roman, I sold my company in August, but I took the money into my company bank account. Do I still qualify to now invest the money into a opportunity zone fund? And the answer was yes. And in fact, there may have been a regulational adjustment for some people that sold their businesses in 2019. I'd have to look into this because I do remember reading something about relaxing the 6-month rule, because all of 2019, we were dealing with proposed regs and then eventually final regulations on this tax topic. So the IRS relaxed some of the requirements throughout the year. Now, I don't think they're relaxed any longer, but if anyone sold their company and they really are thinking about still how to deal with these gains, it's something that needs to be looked at.
Really interesting. This is great stuff. Now, so Roman, ask a couple other questions. So you can put the money into this fund, and I'm assuming you can start a new business, buy a business in that zone, invest in somebody else's business? I'm assuming you have any number of things that you can do with those funds, correct?
Yes, we even had a company in Texas that sold, and they were at the time, they were contemplating investing in a new company as long as it was inside of the opportunity zone. So we were creating an opportunity zone in an economically depressed area as certified by the IRS, and they were taking their capital gains and investing it to start up a new business. So they were rolling over their proceeds, for lack of a better term.
Wow.
Absolutely.
Yeah, that's tremendous. That is great. So it's akin to a 1031, but it's for businesses and not the real estate.
It can be for quite a few different things. You're right. It's 1031 for businesses. It's 1031 for equipment. It's 1031 for other types of investments. It's really all encompassing. There's not as many limitations as we first believed.
And I'm assuming you can set up any sort of entity that you want to hold the money in this fund. Is that correct? You can have an LLC. Is it any sort of entity that works, or are there some requirements as far as the entity goes?
To the best of my knowledge right now, I believe it's any sort of entity, so long as it's in the zone, properly set up as a zone fund, then the fund can operate as any type of corporate structure that it needs to be. And again, typically we are seeing them set up as real estate investments. And then we see the business investment come in on the back end with other investors coming into these.
Got it. And one other question, let's say you sell your business, you roll over the proceeds into this opportunity fund. And I'm assuming you don't have to roll over all your proceeds, correct? I mean,
Correct.
You could take 50% of your proceeds and pay tax on the other 50 and roll 50. So
correct.
Okay, so you roll whatever proceeds you want in this opportunity fund, you buy a business, you grow that business dramatically, and you sell it for 3 times what you bought it for. If you hold it for more than 10 years, I'm assuming not only are you foregoing tax on the original investment, you're also foregoing tax on the gain from the sale of that business if you held it for more than 10 years. Is that a fair statement?
Oh, don't get, and this is where originally there was a lot of confusion when they first passed the law that they were promoting them. There was a lot of individuals out there promoting you pay no tax at all. No, you pay tax on the original gain that's invested is only deferred. And it gets the gain that gets the step up to potentially, again, if they give us an extender, 15%. That tax is due right now on 12/31/2026. But all of the investment gain is exempt.
Wow.
So you have a deferral of tax. You're passing it off just like a 1031. And again, we anticipate this extender, which could allow us, you can defer it. If we get the extender, we should be able to defer the tax beyond 12/31/2026. It should be deferral until we, just like a 1031, until we sell the original invested amount.
Well, if you're a serial entrepreneur, this is seriously something you need to be thinking about.
Yeah, we are in not that I don't plug anything. We are currently writing a continuing education program. If there are CPAs or attorneys listening, we are writing a continuing education program that will be much more in depth. That will be produced this spring as well. Just to answer a lot of the questions you've asked, you'll see those questions not just answered, but detailed. And maybe you and I can do a follow-up once I have all that information put together.
I would love to. Yeah, that'd be great.
Yep.
Well, so, and going back to how we opened here, there have been many changes to the tax code. I think we've covered opportunity zones pretty well, unless you think there's something else to mention there. And if not, are there other changes in the tax code that are worth mentioning?
So, of course, one of the biggest changes was the limitation of a 1031 exchange. And Dominic, I'll be honest, I'm in the middle of probably 5 of them right now. So many business owners, we in the M&A industry think the business owners are very adept at 1031 exchanges. And I will tell you that is a huge fallacy. I find that business owners just absolutely do not understand what the 1031 exchanges are. The tax code change to it hurt us. In the past, You could exchange equipment. You could exchange other pieces of business property. So you could sell something and go buy something and defer the tax on pretty much anything that was like kind property, similar property. So equipment for equipment. Example, right now I'm selling a crane company. The cranes could have been 1031'd within the transaction. It can't do that anymore. The new code limited the 1031 to real estate only. So if you have a transaction that has real estate in it, one of the things you have to ask yourself is, 1031 still exist, and do I want to 1031 the real estate portion of the transaction? And owners have got to understand that when you sell your company, if that's part of it, you can defer the tax. If you're going to take some of the money and buy another piece of property, of real estate, we can defer the tax indefinitely if you're going to do that. So then what do we try to do? We're talking about this whole topic is about tax, and I get involved to minimize tax on a transaction. But what do I do if I have real estate involved in a transaction and I have equipment and assets also in the transaction, but I know the owner is going to 1031 the real estate? I try to allocate as much as I can to the real estate because I'm going to defer as much of the tax as I possibly can.
Sure.
And they don't understand that. And when I do the tax analysis and we show them what we call a waterfall to them, and we say, but look what you can do with your real estate, because you just told me you're going to take 600,000 of what comes in and you're going to use 315,000 for a piece of real estate. And again, they just don't realize it's still there. So the tax code took away part of it, not all of it.
Got it. Wow. That is a big change. I wonder how many people really understand that.
They don't. We have a smaller transaction right now that came in, $1 or $2 million. A broker in the Midwest called us, and my first phone call with the owner and the broker on the phone, I just simply asked the question. I'm like, what do you plan on doing after the sale's over? And the owner looked at me and he goes, well, there's a facility that I want to purchase. He goes, we are, of course, Missouri, this is in the Missouri, Illinois area, and the legalization of cannabis has happened. He goes, we need growing areas. He goes, I want to purchase this warehouse and I'm going to lease it to this group as a growing area for cannabis sale. And we said, look, if you're going to do that, we'll 1031 part of your sale. They had absolutely no idea that he was eligible for that. Very simple fix. And we shed $300,000 of gain and we're deferring that tax.
Wow.
So.
Wow. 300,000 of gain, which they could have paid what? Probably 100,000 in tax?
Probably.
Maybe a little less. But
probably. Yeah.
Right,
so,
man, that is
crazy.
Tremendous.
Yep. And I'll step back and say this too. When I gave you the example of the crane transaction we have going on right now, there is still a 1031 possibility within the new code section under section 1045. 1045 is the tax-free exchange of stock of a business. So I have a company come to me last week. It's a very fairly large transaction, X amount of dollars. And they say to me, well, we need to transfer our equipment in an asset sale, and we're going to get hit with taxes. We're going to get hit with sales tax on the transfer of the equipment. What do we do? One of our proposed solutions is drop this equipment into a brand new corporation, which is a tax-free drop under section 351, then sell the stock of that. It's a brand new corporation, then turn around and sell the stock of that corporation under 1045 to the buyer. You will be able to exchange that stock, tax-free sale, and we are able to transfer the equipment. And we're getting around, what we're doing there is we're getting around the state sales tax that's being imposed, because the sale of stock is not taxed, but the sale of equipment is. So we have a 6-figure savings by doing what we call a drop down into a 351 and then doing a 1045. So there are still ways to structure these things under these new tax codes.
If that's not enough right there for people to realize that they need to call you, I don't know what is 355, 1031.
I know. I don't mean to throw out numbers.
It is code, and you are an expert at it. You and your dad and your entire firm. You guys are amazing.
We live it and breathe it. We love it.
You do. I know it. I've seen what you've done for our clients. Roman, it's been such a pleasure to have you here today. We're going to wrap up, but any last parting words that you'd like to share with the M&A Unplugged community, and then let's make sure we get everybody your contact information.
Sure. Last words, just don't be afraid to ask. Don't be afraid to call. Find out what your after deal flow looks like. Like Dominic said, before you get involved in a deal, maybe as soon as you talk to a broker like Dominic or an M&A advisor like Dominic, ask. Don't be afraid. The owners that are listening, the community, don't be afraid to ask.
Awesome. Roman, how can people get in touch with you if they have some questions?
So the best way, our website is taxplanning.com. My email is rbasi@taxplanning.com. Our phone number is 618-997-3436. And I'll tell you this, we offer this to the whole community. We review deals at no charge. We review your tax situations at no charge. We then have a phone call with all of you at no charge, advisors, brokers, owners. And then we follow that phone call up usually immediately with an email, a quote for our services, and what we can do. We have had a great 2020. We are only looking forward to good things. That's how you can contact us, and that's how we operate.
That's great. Roman, thank you so much. Really appreciate you being here.
Thank you for having me.
So M&A Unplugged community, there's so much there to discuss. I normally do a recap, but there's so much detail here. Listen to the podcast again, or pick up the phone and call Roman or email him. You won't be sorry you did. I mean, he can really help you think through your tax situation pre, post transaction. And the sooner you do this, the better, because there might be some things that you need to do and change in the structure of your business and the way you're running it today before you decide to take it out to market. And that'll give you the window of opportunity to make those changes. So when you decide the day arrives that you want to sell, you don't have to scramble and make a whole bunch of changes and delay that moment. You're ready to go to market. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.